Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money.
Hello and welcome back to Angels Decoded. We've made it to episode number 4. I'm Andy Walsh from Startups Decoded, and my friend here, Cheryl Kellond. Welcome.
Hey, glad to be back.
Today, I want to let you set up what we're talking about.
You're gonna tap into my energy from this past week. You know, every angel wants to be directly on the cap table. It feels like the real deal for them. But my perspective after the last few weeks is that if you don't know what a ROFR is, you could actually be slowing the founders down. Can we talk about that today?
Cap tables. Cap tables, for those of you who don't know, in simple terms, it's basically distribution of shares in one document so everyone knows what percentage everyone is holding on to. Pretty functional type document, but plays a significant role as the company evolves, and it's impacted from the very beginning with your founders, the different types of contracts like a safe note or a convertible. But there's something about status, which I'm hearing from you as far as showing up on a cap table for people that have got a sniff about this new thing called angel investing and want to be a part of it. Can you take us through? I love this part of it, is that the cap table is something that plays a functional role, but it also has a lot that goes behind it. What are some of the things from a founder day-to-day perspective? What are the things that they're looking for to try and minimize so they don't have to look at it very often?
Yeah, so let's take a quick step back here. So much of the conventional wisdom in angel investing is driven by VCs teaching it. And VCs are a different beast. They have a professional job to do, and they need to be directly on the cap table. Because if you are on the cap table, you've got direct access to the founder. You have, in many cases, you can vote on different things as a shareholder, and often you get deeper information rights to what's going on with the startup. So from a professional investor view, it makes perfect sense to be on the cap table. And so angels have walked away with, ooh, I want to be on the cap table too. What they don't realize is there is a real price tag to founders for them being on that cap table, both monetarily as well as expediency-wise.
Okay, so there's the headline, the hero part of being on a cap table. It feels like it's a trend that people are jumping onto. But can you tell me about the influence? You talked it there a little bit. Once you invest in a company, you have different types of shares that open up different types of things. Sometimes you get voting rights, sometimes you don't. Do you think that the putting the money down, that people empower themselves to have influence that they don't or shouldn't have?
Absolutely. Absolutely. Most angels are just learning about startups. And, if you sit on that cap table, there's a few things that most angels don't understand if you sit directly on the cap table. First, I've seen angels balk about having to pay a cost to be part of an SPV. Right? An SPV is a legal structure. It has fees associated with it. And they're like, well, I want to be on the cap table because that's free. What most of them don't know is that it's actually not free. The founder is going to pay over time for every individual person on that cap table. AngelList estimates that the founder is going to pay an average of $1,500 to $2,000 for every individual that shows up on their cap table. And that comes through direct regulatory filing fees and also indirect fees, right? Every time you do a financing round, every time you need to put something out to vote from your preferred shareholders, your lawyers need to update documents and send DocuSigns, and that administrative cost adds up. So the founder you're trying to give money to is actually going to pay more to have you on that cap table directly. But the financial cost is not the biggest risk. It's in the time cycle cost. I was in front of a group of angels the other day, and there was a little kerfuffling of, oh, I want to be directly on the cap table. And I said, great. Everyone in the room, raise your hand if you know what a ROFR is. And no one raised their hand. If you are directly on a cap table, one of the first things you'll have to do as an investor is sign some documents, and a ROFR is part of those documents. It's not actually a complex document, but if you don't know what it is, you are invariably going to slow that founder down. I had an angel that actually delayed an acquisition for a full day because she didn't understand the documents. She actually didn't understand that she was going to get pulled along with what most investors were doing. And she insisted on having her lawyer review all the documents she was signing. Whole acquisition, room full of 40 people, come back tomorrow. This person hasn't signed.
Wow. Yeah, the influence of that is significant. And an acquisition period as a founder is stressful enough. You basically double your workload. You've already got the business to run. You have to keep pipeline strong. You have to keep operating costs steady. If anything goes off the path, it can collapse the deal. So you don't need some random angel making that even harder on you.
Right. And think about it too. If you're doing the right thing as an angel and building a diverse portfolio of 30 to 50 startups, do you want 30 to 50 sets of documents you need to sign every 18 months or 24 months, clogging up your inbox, or when you're away on vacation that you need to be paying attention to? Like, you're giving yourself an administrative burden that maybe you actually don't want.
So quickly, I want to go back a step. Can you spill the beans? What is ROFA the acronym for?
I was not going to define that. It actually just means right of first refusal. And it means, the founder can and the board can decide when something happens or not. They can make the first decision.
And just from a language perspective, people have heard of dragon tag typically in the sense of class of shareholders, common versus preferred are the two classic that live in there. But
Hmm.
voting rights decisions, etc., that's done for a reason. It's a practical reason to empower the founders to move at pace. Doesn't mean they're disrespecting the capital that you've put in. You can contribute if you like, but small checks into a business, if you had 20 angels and you had to service 20 angels through that whole time, that is a burden from a time perspective, a cost. You talked about it before. You're talking $30,000 to $50,000 a year that you're then spending on fees outside of it. So the SPV, we covered that in episode 3. So if you're curious to dig into what an SPV is, how it functions, etc., and the benefit it plays, go back in episode number 3. You can take a listen. But for today, what we want to look at is the downsides from a founder perspective with small checks. Like the SPV overcomes that. But as far as the information that you receive, can you tell us a little bit around access and assumptions of access as far as an angel investor with an SPV or without? Are they still getting all the same transparency?
Well, this is exactly why people have still held on to, I want to be on the cap table, is because most people that manage SPVs manage them like a black box. Like, I have invested in a few SPVs that I didn't run, and you will never hear from the founder again. You get no updates. You're not directly on their distributions. The SPV manager doesn't forward them through. So you're like, hey, wait a minute. Angel investing, like, tongue in cheek, it's the most expensive paid newsletter subscription you'll buy. Well, gosh, at least send me the dang newsletter, right? So I was going to say a cuss word there. The lack of love for SPVs isn't completely ungrounded. What's changing right now is that the best SPV managers, and I will put myself in that group because this is how play money works, are sharing every piece of information about their angels with the founder. The founder should know who's invested in them. So once you give the founder that information, they do include the angels on their monthly updates. They do include their angels on their asks for help. So I think the simplest solve is not everyone should want to be on the cap table. It's SPV managers do a better job. Don't make this a black box.
Do you think that there's a assumption made that from an angel perspective, that if you're on the cap table, you have greater influence versus through an SPV rather?
I will respond to that from a founder perspective. When you are running your company, you're going to ask anyone for help that can help you, whether you're on the cap table like directly or not. Right? If I've got an angel hiding in an SPV that can introduce me to customers, I'm going to ping on them. And if you ask most experienced founders, I think you'll hear the smaller check angels are sometimes their most valuable investors. They're an easier call. They are more helpful. They somehow have more emotional skin in the game than a lot of your professional investors do. And not just emotional skin in the game, more experience and more relevant experience. Do I want to call on the, 29-year-old associate at my VC firm, or do I want to talk to the 3-time exited founder who angel invested $2,500 in my round? I'm going to tell you which one I want.
And the consideration as well for context for anyone who is angel investing, say we'll use 1 million shares as an example of a number that a company when they form, they decide that they've got 1 million shares, they're going to break up between all the investors. As an angel, you might be lucky to get 5,000, 10,000 shares. So if you think about that in context of having 1 million shares, your contribution from a voting perspective is redundant from day one. It doesn't matter whether you're on the cap table or not. Ultimately, following on from what you just said, your role is to actually help them succeed. You've put money down, so you're invested in them literally, but you're also invested in them from a practical perspective. So you don't want to be a burden. You don't want to slow things down. You want to put them on your shoulders ultimately so they can be the best version of themselves.
And that's one of the biggest reasons I think angels are often more valuable than actual VCs, because the angels can be supportive of a founder like that, like an actual human. My favorite story is I closed $1 million sale at my last company solely because an angel pinged me the day before and just cheered me on and said, keep going. No institutional investor was going to do that on a random Wednesday, but an angel will, and it matters.
Yeah, they have you back. And play money is such a perfect term. And going back to your company, in the sense of for some people who can afford to do angel investments, it does feel like play money and it's a hobby. It's like you're having this real life version of Monopoly. You're putting money down and you're part of something. It's exciting. But you need to think about the value that you add and not create a scenario where they need to do more than what they should. And know your strengths. Make sure that the founder knows what your background is and where you add value. And to your point earlier, they will tap on your door if they need help from you. And that's where you all win together as well. So just be aware that being on the cap table doesn't change any of that. Like a good SPV will make sure that you're known, the founder knows who's on the cap table, and how that becomes a functional relationship ongoing.
Absolutely.
I want to carry on a little bit with that. And again, it's attached to the legacy of being on the cap table as power, but dilution is a reality of any investment. Some VCs are trying to do the power move of having non-dilutive shares when they get in early days, but let's not cover that today. That's someone else's spicy topic to pick up. But from an angel perspective, there's typically two types of contracts where you have a safe note and a convertible. And within that, you basically put your money down, and SAFE is another acronym, which we love doing in this space, or you get an allocation of shares. And within that, you're always going to get diluted no matter what. Can you talk us through what that typically looks like with an angel investor as they move through the various stages of investment, just to set up expectations that you will get diluted, but there's something still really powerful about being in from day one?
Absolutely. I want to do a whole episode about dilution because I see angels get wrapped around the axle about this. And again, it comes from the same place. Most angels have learned about angel investing from VCs. VCs are running a different kind of math and a different set of constraints, and dilution matters to them. On the angel side, if I were to quote my favorite data scientist, Abe Othman, you shouldn't double down on bets. You shouldn't worry about dilution, because what you should be focused on is if you're getting in early, it's the entry price you're getting in at. If you get diluted, if the company is doing well and has a chance of, paying out returns, you're getting diluted because the company is growing and getting bigger and taking in more capital that they are using to grow even faster. So dilution is a good thing, right? You might have half the number of shares, but they're worth 4 times as much. So that's really the multiple math you should look at is, over time, if things are going well, dilution's going to give you. The flip side of dilution is your investment is worth a lot more. And if things aren't going well with the company and it's worth less, well, it's just worth less. So things aren't going well. Sort of the game with startups.
It's basic math. You get a share
Let's
price.
math the math. Yeah. It's just
Yeah.
math.
Yeah, you basically get shares at such a low price that the quantity you have is not really relevant. When those shares start to 10x, 100x, you put down $10,000 and you get $1 million back. That's pretty good going in my mind. And just for context, I was reading just yesterday a report from Carter, and they looked at the typical allocation of shares of a founder going right through to Series E on a traditional funding route. And founders in Series E had 13% equity in their own company by the time they got to Series E. So talk about dilution, but for them, that 13% at Series E is worth so much money from the earlier stages is because their share price, so everyone's getting diluted. It's not some trick or something that's happening to push you out. It's actually a benefit to what you were saying.
Absolutely. Back to our original conversation, whether you're on the cap table or on the SPV, that doesn't change unless you are writing a very large check, like 6 or 7 figures, or are best friends with the founder. You're not going to have the opportunity to invest more at those later rounds.
The exposure is interesting as well because you're getting a front row seat to that company growing, and the connection that you make also with an SPV is really beneficial as well, and that creates more opportunities. So the SPV itself and Play Money is a perfect example. Focusing less on the cap table, which I know is our topic, but can you just give us a little quick peek behind the curtain on the upsides of being an SPV as well, just from a practical perspective with the people that you're investing alongside?
Yeah. Oh, good question. I mean, we've seen old friends find each other through SPVs. We had 2 SPV investors that reacquainted with each other after they had dated in college. Like, it's like a giant love connection on those SPVs. Former high school friends. So it gets juicy and spicy on a personal level. More of what we see is people are learning from each other. They're seeing why other people invested in a deal. They're seeing the questions they ask, and they're becoming better angels through that process. And they wouldn't have been exposed to that, or even the company they're investing in, had they, insisted on only investing in companies that they could be directly on the cap table for.
Was a loaded question because I wanted to have you explain it in a way to help angels understand that being on the cap table does not mean anything. There's actually upsides on being an SPV. You might find your future husband, but you also
Exactly. I took that in a weird direction, didn't I? But all of it was true.
But no, in all seriousness, though, you are part of a team that has the skills and the people to be able to manage the day to day. But the connections you make, the intelligence that you learn, the opportunities that are created with other investments in other companies from that group as well. There's so many upsides. So I just want people to focus the fact that it's not what it's cracked up to be on the cap table. Think about the practicalities of that. And that's what Shez, my friend here, is telling you. So, take a listen and do some research because, again, we sent this at the end of episode 3 when we talked about SPVs. It is complex and there's acronyms for days. You have to have intelligence alongside education to understand it and to manage it. And there is a cost. So for me, SPVs all the way.
I can fully support that, both as the runner of SPVs and as a founder.
Two-sided fence. Founders, it's much easier on SPV. Angels, it's better on SPV. Today, SPV is the winner.
I love it. Boom! Problem solved.
That's a perfect way to wrap up episode number 4 of Angels Decoded. Andy Walsh, Cheryl Kellond. We'll be back next week.
I'll see you next week.
Been a dream. Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.